If you want to trade like a rebel, you got to come to RebelCon 2022. It's going to be in Dallas, Texas, at the fabulous Four Seasons Resort. It will be more fun and more live trading than we've ever done before. That's why it's called RebelCon 2022. We're going to have barbecues and double the amount of live trading. The guest speakers, as soon as we announce those, this thing's going to be sold out, limited to 250 people. Sign up now for RebelCon 2022 at the Four Seasons in Dallas, Texas.
Welcome to the rebellion.
Hey, Market Rebels, and happy Thursday, everyone. And a lot to be happy about because we now have our 12th candle above the 50-day moving average on the SPY, the S&P 500. I didn't see the actual close, but I think we were pretty close to unchanged. But it's a doji. We're going to be talking about candlestick formations in the future, lots of different candlestick patterns and their significance. But for right now, just understand that that shows a sign of indecision. The bulls aren't really ready to push it above that price. The bears weren't willing to push it down, just a little bit of a standstill. So we'll have to see what tomorrow brings. But at least we are making tracks still to the up direction. So for today, what I thought would be helpful is to talk more about relative pricing. I've talked about this in the past. We did a presentation on relative pricing with vertical spreads. So today, let's take a look at relative pricing with straddles. So relative pricing is this whole idea that we don't even need a pricing model to find certain trades, to see if one strike or expiration might be better than another, at least in terms of giving us an edge. So without having to go to a pricing model and more advanced tools, if you understand your strategies, you can look at the prices relative to each other. And the beautiful thing there is that we don't need to know if they're low in terms of volatility or if they're both high. It doesn't matter. We just know that relative to each other, that one is cheap and one is expensive, and that's really all we need. So let's take a look at relative pricing with straddles. So another good use of options, even if you don't plan to trade a straddle. But quick review of a straddle. It's a strategy where you're going to buy a call and a put, same strike, and the same expiration. So for instance, let's say that you buy the $100 call for 5 and you buy a $100 put for 5. We would say that you are long the 100 straddle for 10. That's just the combination of these two prices. So this would be our risk graph. Notice at the bottom of the V right here lines up at 10. That's the amount we paid, and that is the theoretical maximum that we could lose. Now again, as I've mentioned before on straddles, you have to be careful about saying that this is the true maximum. I mean, on one hand it is, but the chances of having that happen are pretty slim because the stock would have to close at exactly 100.00 in order for that full maximum loss to occur. The break-evens will be plus and minus $10 or whatever we paid for the straddle, added and subtracted from the strike. So we would have a lower break-even of 90. That's just the 100 strike minus the 10 cost. And we would have a 110 upper break-even. That's just the 100 strike plus the $10 cost. So we have this wide range in here for losses. And that's why the straddles aren't necessarily the best strategies, especially in high volatility environments, because only the call or the put is going to win, if at all. And so it has to make up for the others cost. So in other words, you're buying a call for the price of a call and a put, and you're also buying a put for the price of a put and a call. In a sense, you're almost paying double for the options. So again, that doesn't necessarily mean that you don't want to learn a straddle. We can use them for relative pricing. So for instance, let's say that the stock is at 104 and we have the 100 straddle trading for 780. We have the 105 straddle trading for 760 and the 110 straddle trading for 740. All right, so can you find the mispricing here? Okay, so if it's not jumping out at you, this is a perfect example of why you need to know your options and your options theory. This is a beautiful trade setup right here, and most people will completely miss it. So what are we looking at here? They're all trading for roughly the same price. Stocks at 104, how can we break the tie? Well, in order to find out if there is a mispricing, we have to fall back on a couple of principles with straddles. And that is, as the strikes move further from the current stock price, the straddle prices increase. So here's why this happens. Let's take a look at the 105 straddle. This was the center strike that we just saw. And the stock is at 104. So the put option is slightly in the money by $1, call option slightly out. You can see we're starting to ride up this negative delta line a little bit. But watch what happens if we also overlay the 100 straddle. Look what happens. Now this blue dotted line is sitting higher on one of these legs. See, it's sitting much higher on the right leg than it is on the left leg here in black. What happens if we look at the 110 straddle? Okay, we move out this way to the right. Same idea. Now where this blue dotted line intersects this green, it's sitting very high up on this delta curve. The put's in the money. All right, so as we push the strikes higher, the puts go in the money. As we push the strikes lower, the calls go in the money. So here's maybe a better look at it. Let's look at the 90 strike here in red and the 120 strike here in green. Keep the stock at 104. What do you notice? Okay, if you look right down here, there's just not a very big amount of deltas. Again, that's what we saw before. This blue line is only sitting slightly up on the left-hand side. But take a look over here on the left. This right leg over here from the call that's a 90 strike, so that's 14 points in the money. See, this one in black only has one leg that's $1 in the money. Take a look at this in green. Where it intersects that blue dotted line is now 16 points. That's the 120 straddle with the stock at 104. One of those legs, this is the put, is $16 in the money. So that's why straddles become more valuable as the strikes get pushed away from the current stock price. And sometimes this catches traders off guard because they've usually heard that as we move out of the money or push the put strikes lower, the call strikes higher, that options become cheaper. And that is true. We are pushing the call strikes higher here in green, but we're also pushing the put strikes higher. And that's putting them in the money. For the red curve, yes, we are pushing the put strikes lower, but we're also pushing the call strikes lower. And that's putting that call in the money. So again, the idea to see is that as we move those strikes, those straddles away from the current stock price, the straddles should be getting more expensive. So let's go back to those prices. Stock at 104. Here are the three straddles. All right, so what's the trade we should make? What do you notice? Well, we know that the 100 straddle should be more expensive than the 105, and it is. Is it too expensive, not expensive, or too little, too much? Well, for that, we'd really have to dig into a pricing model. But I can at least tell, relatively speaking, that it's at least in line. But what about the 110? It should also be more expensive than the 105, and it's not. So one of the basic things that you do is to buy the relatively cheap one, sell the relatively expensive one. So the trade here would be to buy the 110 because it's relatively cheap, and we sell the 105 straddle because it's relatively expensive. So again, the importance of this is I don't even need to go to a pricing model. For all I care, they could both be super overpriced in terms of volatility. Doesn't matter. Relative to each other, the 110 is absolutely a better deal. Now, what's going to happen with this trade? This is another aspect of options that I usually teach traders is how to visualize or at least be able to sketch these out. You're going to have to start out by sketching them on paper, and eventually you can do these in your head. If somebody mentioned these, I can graph these and immediately see what's going to happen. Everybody in here can. It just takes a little bit of practice. But here's the long 110 in blue. Here's the short 105. Take a look at what's going to happen. Look at the first strike right here at 105. All of these positive deltas over here are a mirror image over there. They're just going to cancel out. And that tells me that at this strike, we should see a flat line on that risk graph. Take a look at this strike over here. All of these positive deltas have a mirror image of negative deltas. They're just going to cancel out. And that tells me that right here at this strike, we should get a flat line. What should we get in between? We should have negative 200 deltas. We just are going to have two bear spreads. Okay, so right in between there, we've got negative 200. So another way to see it that you can sketch it out, let's look at calls on the left, puts on the right. Here are the strikes. Here is the long 110 straddle in green. We're long the 110 call, long the 110 put. Let's look at the short 105 straddle. You're short the 105 call, short the 105 put. But look at them vertically. This is just a credit spread right here, right? You're short the 105 call, long the 110. What is this over here? It's a debit spread. You're long the 110 and short the 105. They both have a bearish bias. They both have 100 deltas at expiration. We have two spreads, so we have minus 200 deltas. So that's going to be our risk graph. Now, the benefit is that if we look at where the stock is, all right, remember the stock is at 104. All right, so where does our edge come in? This isn't quite an arbitrage, but it's the next best thing. It's giving us a mathematical edge. So let's look at a bell curve, which is roughly what we can expect from the stock prices over the next 30 days, 60 days, 2 weeks, whatever the time frame is here. The more volatility, the wider and flatter that bell curve gets, but it still gives us the same idea. So notice that for all of these prices, right up to where the blue line crosses zero, look at how much of that curve is in green. We have a much higher probability of being in the green than we do in the red. That is the edge that we're looking for. So again, it's not guaranteed, but it just gives you a high probability for success. And another thing that's interesting is, in this case, you wouldn't even need to be bearish. It would certainly help, but even if you were bullish, mathematically, it would still give you an edge. And that is the beauty of relative pricing. But in order to do that, you have to understand your strategies and your options theory and your synthetics. Sounds a lot more complicated than it is, but for anybody who'd like to learn more, this is an absolutely fabulous opportunity to get a free 30-minute one-on-one consultation with one of our world-class coaches. I mention this every time. Many of our guys have decades of experience on the trading floors, and there you have to be absolutely razor-sharp nails to understand your synthetics and your strategies to be able to manage that much risk. So imagine what they can do for you when you're just managing the trades that you want to take. And are you missing opportunities? And most of the time, people don't even know it because they don't even recognize it. So here's the phone number to call, 888-809-8058. Absolutely free consultation. Please give them a call, and that's going to put you one step closer to making better trading decisions. So we're going to look at more of these in the future, of these relative pricing examples, but I hope this at least gave you something to think about. And most of all, I hope it helped you to make better decisions. So we'll look for you tomorrow, 4 p.m. Eastern Time.